Well, good evening. My name is John McDonald, member of the New York State Assembly here in the 108th Assembly District, which is Albany, Rensselaer, and Saratoga counties. And it's our pleasure. We thank you for joining us this evening on our home ownership program panel that we have this evening. As you may know, and if you don't know, June is Home Ownership Month. And our goal this evening is to present what I would say, numerous or bountiful resources available to you here in New York State to help you realize the dream of home ownership. As you know, recently the Times Union actually did a very in-depth review of the redlining that's happened within the city of Albany. And it's talked about a lot of different practices that have been going on for generations, of which I can assure you at the legislature, we are trying to address those issues and those barriers to home ownership. Many people find home ownership a daunting task and sometimes get caught in what I call the rental rut, where they're paying a good $1,500 to $2,000 a month for rent, when in reality is working with strategic partners and being a little bit more aware of the resources that the state and other entities offer, one could very easily flip that rental rut into a home ownership opportunity. New York State government, of course, has SONYMA, which is the state of New York mortgage agency, and it has first-time homebuyer programs and financial assistance available that is going to help reduce those barriers. I should also say, as a former mayor, and I can't help myself, that many communities throughout our region have adopted the first-time homebuyers tax exemptions, which is something as you're looking through the process, should be reaching out to communities to see if they have that available, which provides relief not only in regards to your city taxes, but also potentially your school taxes, which usually school taxes are usually the lion's share of the property taxes that you pay. We also are very fortunate this evening to have some nonprofit housing counselors, people that I am proud to work with, not only in regards to helping people stay in their homes, but also to help guide them through the process, and you will hear from them this evening. And we also have a loan officer who specializes in SONYMA mortgages. So as you can see, we've got all the players on the right screen at the right time. Make sure you have whatever documenting notes you have available, whether it's pen and paper like people like I still use, or your iPad, whatever it may be, because we have a very we have a tight agenda, but it's an informative agenda. I'm just going to introduce those who you can see on the screen this evening, and then I'm going to turn it over to our moderator for this evening. But Sue Codner, excuse me, Sue Codner, which was with the Affordable Housing Partnership, is going to review the home buying process. Paul Hurley, who's with M&T Bank, will talk about how to credit qualify. That's something that many people don't usually think about. And it's probably the most critical element to think about outside of selecting a safe building. Bill Teague is with SONYMA, the state lending agent, and they are here to basically give you credit, and they'll walk you through that process. And then we're going to jump onto the other side of the river over in Rensselaer County to an organization that I also love to work with, which is TRIP, who works on many different levels. And Caitlin Burns is joining us this evening, and she's going to discuss other grant programs that are out there. So this webinar is being recorded, so you can always play the rerun if you'd like. And without any further ado, I am going to turn it over to my friend Sue Codner, who will lead you through the rest of the evening. Thanks, Sue.
All right. Thank you so much for that great introduction. Yeah, we're excited to be here tonight. We're glad you're here. What we want to try to accomplish is provide a little bit of an orientation to the home buying process. And we really believe that learning about the financial products is a key first step. Are you financially ready? And we'll talk about that with you. We are just a few housekeeping things. Again, this is a webinar, so we cannot see you. You all are on mute. So what we would love for you to do is to use the Q&A and the chat feature, and we'll stop every once in a while to answer your questions. That's really, we want to be as interactive as we can on Zoom, which is a process we know. So we're glad again that you're here. Please use that Q&A and the chat feature. We'll move ahead. So I'm going to start off just giving a little bit of an overview of the home buying process. Again, we're advocates of getting smart about the home buying process and meeting one-on-one with a housing advisor. Both Nicole from TRIP is here and myself. Our agencies have been around for over 30 years, helping first-time home buyers navigate this process where you're working with a lot of different people on your team. There are two other really great housing counseling agencies in the region. Better Community Neighborhoods is based out of Schenectady, and then Albany County Rural Housing Alliance. So at the end of this presentation, we'll be emailing you some ways to follow up with us, and we'll get you their contact information as well. So we're really glad to be able to partner and work collaboratively to help address first-time homebuyer questions and needs. You know, once you have decided that you're financially ready and you want to move forward, and again, we can help you get the information that you need in order to make that good decision. One of your first steps is to meet with a loan officer, figure out how much of a loan you qualify for. And then with that information, right, you're going to go ahead and meet with a realtor, a buyer's agent who's going to help you find a house, you know, that fits your needs and is within your price range, and is a really good experienced set of eyes looking at properties with you to help make sure that you're not getting a real dud. Right? They want you to be successful in home ownership. So your realtor is a really important partner for you. Once you're under contract and your realtor will help you get to that place, you've come to terms, you know what price you want to pay, and the seller's agreed to your terms. One of the most important things that you're going to do is get a professional home inspection. In New York State, home inspectors are licensed. You'll want to pay, that'll be one of the fees that you'll pay for upfront to get a professional report on the complete condition of the property to make sure that you're getting into a home that you know that you can afford to maintain and keep. You're going to work with your real estate attorney to have them review the contract and make sure it's a solid contract. Most of the standard form contracts in our area in the capital region are fair to both you as the buyer and to the seller. Then once you have gotten kind of the sign off from them, you'll go back to your lender and formally apply for a mortgage loan in the amount that you need for this particular house, right? You've been pre-qualified early on in the process, but now you really need to come back and actually do that formal loan application now that you know what house you're buying, what the property taxes are, and that type of thing. By this time, you've spent a fair amount of money, right? So we always like to just make sure that people are aware that it's hard to get into the home buying process with zero cash, even though you might hear about no down payment programs. You do need money to come to start the process. You'll need to put down a good faith deposit. In our market, that can be $1,000. You'll need to pay for that home inspection, $450 to $500. You'll need to pay for your homeowner's insurance up front. The lender will want to know that the house is properly insured at the time that you buy it. That might be $750 or so. There'll be some loan application fees. So we really coach people that at a very minimum, you have to have at least access to $2,500 to $3,000. A lot of people say that if you can get to $5,000 to $6,000 of your own savings, that's great. But there are a lot of other programs, and Nicole will talk about those, and so will our mortgage partners about the other grant resources available. Once you've gotten the clear to close, you're going to actually sign a lot of pieces of paper and be able to move in to your home and get the keys. So again, a lot of folks involved in this whole process. The smarter you are about what it takes to get to closing, the better. And again, more confident that you'll be, and the more control you'll feel like you have over the process. So again, I keep saying that word process. That's kind of the feedback we get from the first-time buyers we work with. It's something you get through, and we're here to help you to get through that. So I have a second slide that I want to talk about, and basically it's the scary slide, right? It's how much cash do you really need to have in order to move forward with this process. A lot of the families we're working with now these days are buying $150,000, $200,000 homes. That's unfortunately just where the market is at right now. Most bank products want to see that you come up with a 3% down payment. The good news is it doesn't all have to be from your own personal savings, right? There's a lot of great resources, and we're going to talk about that tonight. But you do need to know, again, where that money's coming from. Where's the down payment? Where are those one-time closing cost fees that you'll have for your attorney, for taxes, for your title insurance, mortgage recording tax, that type of thing. You'll need to make payments toward property taxes at time of closing as well. So very easily, you're buying a $150,000 house. You'll need to know where you can come up with $13,000 to $14,000. We'll help you do that. So every house that you look at, that's kind of math question number one. How much cash do I need to actually purchase this house? And then most importantly, every house that you look at, there's a second math calculation, and that is, what does it cost me to own this home on a monthly basis, right? What's my mortgage payment? Part of that, again, the principal and interest on the loan, 1/12 of your taxes, 1/12 of your homeowner's insurance, and then you may or may not have a mortgage insurance premium, which you'll learn more about as you go through the home buying process. So again, can you comfortably afford a $1,300 a month payment? And that's part of what we would review with you is, yeah, you could handle $1,300 a month, but that means you're going to be eating spaghetti for the rest of your life, right? That's not what we want for you, right? We want to make sure that cushion is there. Or if you think you can easily handle $1,300 a month because that's what you're paying in rent, right? That's what a lot of people are paying. That's great. And so let's move forward, with that information. A mortgage payment is not your only cost of ownership, though, right? You do need to think about what kind of condition is this house in? How much do I need to set aside every month for repairs and improvements? My utility bill as a tenant now is $35 a month, right? It's just very minimal. As a homeowner in this big old drafty barn, it might be $250 a month. So again, understanding your total cost to own and what's that comfort level that you have with your own current spending plan, what adjustments do you need to make, and how comfortable are you making those adjustments? That's the conversation that we look forward to having with you going forward. So with that, I'm going to turn it over to Paul Hurley, who's going to talk about qualifying for a mortgage loan. Although let me do this one quick thing. I do have one Q&A. And the comment is about property taxes in upstate New York, making homeownership difficult because it is so high. Are STAR tax breaks still being offered for seniors or the disabled? And if so, what would that look like? So yes, the answer is STAR tax breaks are still available. One of the challenges, though, right now is that it's something that where you have to pay kind of the full amount of tax, and then you get a rebate on that, after at the end of the year, after you've paid that school tax bill. So again, Assemblyman McDonald, do you want to respond to that? Except you're on mute.
Yep, I'm not. So actually, I was just typing an answer to that, but Sue, you're absolutely right. Now it's the STAR tax credit. And basically what happens is the state now has all the information through tax and finance. They actually send you a check that actually will cover, which is similar to the exemption that you're having before. And the good news is they've been very proficient. Most school taxes are due in September, and you usually get it probably late July or early August. So it's still there, and it is a big difference in regards to your overall net payment for property taxes.
So again, it's kind of that discipline of saving that money then that you get so that you can use that towards that monthly payment. So, but again, it does come in very quickly, afterwards. Good question. Thank you for that. All right, Paul Hurley.
Thank you, Sue. Thank you first off all for being here tonight. I really do enjoy doing these homebuyer seminars, and you guys are starting out in the right spot, getting yourselves educated so that you know what you're getting into as you go along. I enjoy nothing more than attending a closing with first-time homebuyers who have understood all the way through the process. So kudos to you guys, and thanks for doing this. So we're going to talk a little bit about qualifying for a mortgage. So as you can see, there's 4 C's: capital or cash, the capacity to borrow, your credit history, and the collateral. We're going to touch on each of these. So Susan touched a little bit on what you need the money for as far as capital or cash. You're going to need money for your down payment. You're going to need money for your closing costs. You're going to need money for your inspections. So as Susan mentioned, if you stay up late at night and watch those shows that say that you can buy a house with no money down, please understand you can't do that. There are some programs which do allow for 100% financing, such as VA and USDA. There are some programs that do allow the seller to pick up a portion of your closing costs as well. But any way you look at it, you are going to need some money. The capacity to borrow, that is how much can you afford? Oh, I'm sorry. I didn't realize we had another slide. Sorry, Susan. All right, so sources of your capital or your cash. So savings is a great one. The more money that you're able to put aside, the more of your own money that you can put into this, great. In addition to that, you have the opportunity, if you've got a family member that wants to assist you in purchasing this home, you can get a gift. There are also grants available that Nicole will be talking about in a little while. And then there's also a seller concession. So let's say you've talked to your lender and you figure out how much money you need and you're just a little bit short. You can ask the seller to assist towards your closing costs as well. Generally speaking, what they're going to do is bump up the sales price of the house a little bit to cover the concession that they're giving you. I will tell you that right now in the market that we're in, there's a lot of sellers that are not interested in helping with the seller concessions because there's a lot of buyers, many of whom don't need them. Where are you going to use that money? You're going to use it for the down payment. You're going to use it for closing costs, escrows. Right after closing, you're also going to need it for moving, immediate repairs, and then decorating. I can tell you from personal experience, it doesn't matter what color your white bathroom stuff is, it's not going to match your new white bathroom. It just doesn't work. All right, your capacity. So this is where the lender really comes into it and really starts to help you out. We're going to try to figure out how much of a mortgage can you qualify for. When we do that, we take a look at your income. We look at your gross income before your taxes, whether it's salaried, overtimed, and such. We want to see a 2-year history of working, generally speaking, within the same field. So you do not have to be at the same job, but we do want to see that you're within the same field. If you're a recent college graduate, we do have programs which will allow you to do it without a 2-year work history by using what your college was as your background, okay? You can also use things such as pension and Social Security. If you receive alimony, child support, or maintenance, we can use that to help you out. If any of you receive Section 8, that can also be used to help purchase a home in many cases. Keep in mind that if you've got a part-time job, we do need a full 2-year history of you working 2 jobs in order to use that. Basically, what we're looking to see is that your income is stable and reliable. So if you work various hours over time, maybe one week it's 30, and next week it's 35, the next week it's 40, we're probably going to need to see 2 months worth of your pay stubs in order to get a good sense of what you're earning. If you've got a straight salary, it's a little bit easier. Any of you that are self-employed, we're going to need to see a 2-year work history by collecting your tax returns. We are going to average it. And I know coming out of the pandemic as we are, that's a challenge for a lot of self-employed borrowers because last year was tough. But we are going to have to take a look at it, average it, and then also take a look at where you are so far year to date. So generally speaking, you want a 2-year history. The flip side of that is, who do you owe money to? Okay, what debts do you have? Car loans, student loans, personal loans, etc. A couple very interesting things. You want to make sure if you've got student loans that you talk to your loan officer and make sure you get an idea of what type of program you're going to use. Different loan programs have different ways of looking at student loans. Some will use your income-based repayment. Some will require us to use a 0.5% payment. So that's a little bit difficult. Credit card payments. We're going to look at the minimum payments that's owed on your credit cards. If you have to pay alimony, child support, or maintenance, we do need to know that as well because we're going to use that when we calculate your ratios, which we'll go into in a moment. One of the things that you're going to do is your loan officer is going to get your credit report pulled early on, and you're going to go down through. So let's say you are a little bit over where you want to be. Your debt to income is a little bit too high. Maybe you can pay something down. In a lot of cases, if you can pay an installment loan down, whether it's a personal loan or a car loan, down to under 10 months, we don't have to hold that loan against you. Okay, so we are able to find ways to do that when we do it. Again, it's really important that you have a good conversation with the loan officer that you're talking to, especially about things like alimony and child support. I can tell you that I had an experience where I had a gentleman and I asked the same question on every application that I do. I ask very straightforward, do you pay alimony, child support, or maintenance? And the individual said no. They went ahead, they got qualified for a $185,000 mortgage. When the time came that they applied for the mortgage and they turned in their pay stubs, there was a garnishment on the pay stubs from Albany County Support Collection. So I called the borrower up and I said, you've got a garnishment. He says, oh, that's my child support. I said, but you told me you don't pay child support. And he said, I don't. They take it out of my check. So it's really important that you have a conversation and let your loan officer know everything that's going on. Okay? Debt to income ratios. You're going to hear this a lot, especially when you talk to your loan officer and when you talk to the different grant agencies. Depending upon the loan program that you go through, many loan programs will allow you to use anywhere from 35 to 40% of your income to go to just your mortgage, and they'll allow you upwards of 45% of your income to go to your mortgage as well as the rest of your monthly debts that we just went through. I will tell you that I'm very happy that we're on Zoom on this, because when I say 40% for your housing ratio, Sue throws things at me, okay? It is better if we can keep your housing ratio lower, okay? Because that way you've got a little bit more room and a little more flexibility. Many of the grants have different ratios than the loan programs that we're working with as well. So it's very important that you let your loan officer know what agencies you're working with. For instance, there's a grant out of TRIP, which is a really good grant, but I believe their ratios are 33-42, which means we need to keep you under 33% of your income for your mortgage and under 42. So even though the bank will approve you for more, we have to keep you under the lowest ratios in order for you to get those grants as well. Okay? Credit history. You've probably heard a lot about credit. It's all over television. It's everywhere you go. There are 3 main credit bureaus, as you can see. We're going to pull a tri-merge credit report, which is going to be all 3. Banks use the middle credit score. If there's 2 people that are borrowing, we use the low middle credit score, okay? Depending upon the loan program that you go with, some require, some have different rules with regard to the credit score. SONYMA, which happens to be one of my personal favorites of a loan, does not have a minimum credit score requirement. They do, however, have a minimum credit history requirement. And Bill's going to talk a little bit about that in a few minutes because they've got some great tweaks to their programs. But that's a great program because, again, maybe you've got newer credit, maybe you don't have a lot of credit, but that doesn't mean that you can't do something. Other programs will have minimum credit scores. Some go as low as 620, some go as low as 580. We do like to see at least 3 to 5 different trade lines. Various ones are better, obviously, okay? And generally, we want to have them open for 18 to 24 months. What are the most important things you're going to do early on, whether it's through your loan officer or through the housing agency? They're going to pull a credit report on you, and they're going to assist you in one of 2 ways. If your credit's good enough, they're going to usher you into the pre-approval process. If you need to work on the credit, they're going to work on that credit with you and then work you back into the pre-approval process later. Generally speaking, the higher the credit score, the better. If you get over 740, you're going to get the best of everything. You're going to get the lowest interest rates available on conventional loans. You're going to get the lowest PMI rates that are available, et cetera. So the higher you can get your score, the better. And there's the pieces that you really need to know. What's going to keep your score up? Are you paying on time? How much do you owe? How long have you had the credit? Another good thing about the SONYMA program is, in addition to not having a minimum credit score requirement, SONYMA is one of the few loans that will allow me to use non-traditional credit. So maybe you simply don't have credit. You've never used it, okay? We can build an alternative credit history for you. We can get a verification of your rent. We can use a letter from your automobile insurance people. We can use, canceled checks or paid bills showing that you've paid your utilities. And we can build that credit history for you. And as long as we can get the necessary pieces together, they're going to view it the same as if you had a full credit score. there's a lot of different mortgage programs. The one that's best for you is the one that's best for you. Your neighbor, your coworker, they may be in a different situation. So I get this a lot of times. Well, my coworker did this. Sometimes that's good, sometimes it's not. So you really do want to have a conversation with your loan officer. If you talk to a loan officer and all they're doing is pushing one product and not telling you why, you may want to call somebody else as well. So there's a variety of different things, especially for first-time home buyers. FHA is a great program. It's a little bit more flexible when it does come to difficult credit. It allows the seller to pay the most towards your closing costs. FHA allows you to do 100% of the money can come from outside sources. So none of it has to be yours. You can get a gift. It can also come from grants. SONYMA, as I touched on, it's a 3% down payment program for 1 or 2 family homes. It has some very nice pieces to it that Bill's going to go into a little bit more as well. Down payment assistance, some closing cost assistance, some flexibility and such. Conventional is probably the most popular program that you hear of, Fannie Mae, Freddie Mac. They've also got first-time homebuyer programs for as little as 3% down. Rural development tends to be out in the, it's a USDA program. It tends to be out further outside. You're not going to find that in the city. It is 100% financing. It does allow the seller to pick up some of your closing costs as well. There are income restrictions on it. VA loans, if you are a veteran, you can do 100% financing if you've got your certificate of eligibility. You can also get the seller, again, as long as they're willing to pick up your closing costs. So the VA loan is probably the one product I have that it's actually possible to get in with the least amount of money out of pocket. And finally, there are a number of renovation products available, okay? Right now, one of the things that a lot of people are facing in the marketplace is that it is a very competitive marketplace. If you have a well-maintained house in a good area and you put it on the market, it's going to sell very quickly and probably for over market. So those are going to be very difficult, especially for first-time buyers utilizing grants and such, because the sellers don't have to take your offer. There's going to be other offers that may or may not be better than yours, okay? This is where the renovation loans come in. Perhaps you find a house that really it's, you know, the bones are good, but there's just something about it. It really hasn't been updated. Maybe it's just, you know, it's an older couple that's been living there and they've let it go a little bit. A renovation loan is perfect for this. It'll enable you to purchase the home. It'll enable you to get the money you need to do the renovations to the home, whether it is health and safety items, whether it's required repairs, or maybe it's just sprucing it up, okay? If you go into a house and it hasn't been updated in a while, maybe there's avocado gold, you know, carpeting, and there's some beautiful, avocado green carpeting and some beautiful harvest gold appliances, and you want to update those, you can do that with these renovation loans. You've got a conventional one, a SONYMA one, as well as an FHA one. So if this is something that you're interested in, I do encourage you to take a look into the renovation products.
All right, that is great. So Bill, you're up next with your slideshow, and I'll stop this one. In the meantime, we do have a comment or a question going back to homebuyer counseling and education. So a lot of the first-time homebuyer mortgage programs and grant programs do ask that you attend homebuyer education programs. So again, counseling is a big piece of that for all 4 of the agencies in the capital region. In addition to attending some classes like tonight's class, and a lot of us are offering online education programs. We really do truly feel like an important piece is doing that one-on-one counseling, that conversation that we have with you to help make sure that your questions are answered and that you feel confident about moving forward. And we have that, you know, that individual, let's figure out the path that works best for you. So we're glad for that. All right, Bill.
So can you guys see my screen? It says SONYMA University, give us credit. All right. I wasn't sure if I had done that correctly, so thank you for nursing me through the technology part. So I'm going to go through this. Paul gave you some great information. There it is. I'll go through it slide by slide. This is about some new stuff that SONYMA is doing that we think is really helpful to help people get into homes. Our mission at SONYMA is primarily to help low to moderate income first-time home buyers, right? So if you make over a certain amount of money, you're not allowed, you're not eligible for SONYMA programs. We're really focusing on those low to moderate income first-time buyers. So we're trying to come up with creative ways to do things a little differently than they've been done traditionally in the mortgage business to help get more people into homes. So for 50 years, right, SONYMA has been making home ownership a reality for low to moderate income first-time home buyers from Buffalo to Long Island. Essentially, what that means is throughout the entire state, right? And if you're buying a property in New York State and you're a first-time home buyer, there are some exceptions to the first-time home buyer rule, then SONYMA is something you want to take a look at. Right? There's other programs out there, as Paul said, but if you have an experienced loan officer, they'll look at SONYMA, they'll look at FHA, they'll look at conventional VA, and kind of based upon your situation and the facts of your case, they will make a couple recommendations for you as to what they think is the best product. So at SONYMA, we've just come out with this new initiative. It's called Give Us Credit, right? So we're going to talk about that. We're going to talk about how does Give Us Credit from SONYMA make home ownership more accessible, right? We want to make it meaningful to you since you're spending your time here. And then we'll handle questions, however Sue wants to handle questions at the end of this segment, or wait till the end in general and answer your questions that you might have. So we're going to talk about Give Us Credit from SONYMA. First of all, we'd like to thank Assembly Member John McDonald for making this program tonight possible. Right, he wanted us to pass this information along to you, so we thank you for that, and your office. They've been great, I think, at promoting this and helping put this together. Obviously, Affordable Housing Partnership and TRIP, great job putting this together. And I will say, as an employee of SONYMA, that M&T Bank is a great partner. M&T Bank is not the only lender you can go to get a SONYMA loan. We have about 80 participating lenders within the state. But M&T Bank does more SONYMA loan volume than any other lender in the state, so they know it well. Right. So what is Give Us Credit? Right? Give Us Credit is a new approval design that SONYMA has come up with to address some of the most common barriers to homeownership in historically underserved markets, right, including minority communities. So, you know, there's been this established way of approving, looking at people as creditworthy in the banking industry for a long time. Obviously, people, you know, the banks kind of got out of that mode a little bit about 12, 13 years ago, and there was a big blow up then, and then they came back into being really conservative in how they look at things. And it's one thing to be conservative, but you also want to look at things like from a different angle, because not everybody participates the same in the credit system, right? Like Paul said, he'll pull up credit reports on some people and they have lots of stuff on their credit report, and then he'll pull up credit reports on other people and they don't borrow money very often, so they won't have much on their credit report. So we're trying to come up with ways to help folks that maybe participate differently in the system, either based upon cultural or just based upon, hey, this is what I was taught by my parents growing up, and this is what somebody else learned from theirs, right? So we want to help these underserved markets. So what we've done is we've kind of expanded certain approval guidelines to be more inclusive of households with non-traditional credit. Used to be if you didn't have anything on your credit report and you couldn't document paying any of your other bills, it was really tough to get a mortgage loan. Right, well, we're going to help. We, as Paul said, like to look at folks. If they have stuff on their credit report, that's great. But non-traditional credit is just you're paying bills in your regular life that don't appear on your credit report, right? So if you can document that. Also, non-traditional income, right? Some lenders count a certain income in that debt to income ratio that they were talking about, right? Your mortgage amount per month versus your gross monthly income, and then your mortgage amount plus all your other debts toward that gross monthly income. So we're looking at that a little differently with this new initiative that we have. And asset profiles. In other words, assets is the money that you have to come to the closing table. You know, traditionally, if the money isn't in the bank, it doesn't count, right? Or if it just appears in the bank all of a sudden this month when you're applying for a mortgage, then you got a lot of questions to answer about where it came from. So we tried to come up with some new ways to look at that, with the understanding that a lot of people, you know, don't, as soon as they get money, run and put it in the bank, like some of us do. So that's kind of where we came from. And we also set up kind of an inclusiveness committee with different loan officers and other participants in the process throughout the state to kind of give us feedback, and they really gave us a lot of help on this. You know, it's not that we were geniuses and came up with this on your own. So in other words, where we're trying to get to in the process to help folks buy a home is this basic concept. If you pay your bills on time, whether or not those bills appear on a credit report or not, and if you can afford the payment, right, the payment versus how much money you make, you have the cash to close, either in your own bank account or through grants or through some SONYMA programs or through gifts from relatives or through a loan from a relative. If you can come up with the cash to close and it all works, right, because you can afford all the payments, then you should be able to get a mortgage approval. That's kind of the premise we're operating under now. And that's the essence of give us credit from SONYMA. So when you're talking to your loan officer, if it's Paul Hurley from M&T Bank or some other loan officer from another bank, make sure you ask, hey, let's talk about give us credit with SONYMA. So they talked about, right, the 4 C's of qualifying for a mortgage: credit, cash, capacity, collateral. So we kind of addressed how we're going to look at these things in each of these areas. So the first part we're going to talk about is credit and credit history. Right. Traditionally, mortgage lenders want to see your payment history and credit score on a credit report in order to evaluate if you pay your bills on time. We're not big fans of credit scoring at SONYMA. I mean, we look at payment histories that people have to see if they pay their bills on time, but your credit score really doesn't have a whole lot to do with the decision to approve you or not. And that's how we do it at SONYMA. So traditionally, they want to look at that, right, to evaluate if you pay. Many borrowers don't utilize a lot of stuff that appears on their credit report in their everyday lives. And therefore, they don't have a credit score or they don't have a trade line history on a credit report, right? But we want to give those buyers the opportunity to purchase a house as well. So that was kind of how we were thinking as we put this together. This doesn't mean that they don't pay their bills on time, right? So there's people out there that have, that maybe it's not that they don't have credit. What they have is bad credit. To us, bad credit is bad credit. If you haven't paid your bills on time in the past and you can't demonstrate that you have recently, then that's going to be tough to get approved. But we're really talking about here folks that don't really have any credit, but are still probably credit worthy because they're paying their bills each month, right? They're living, they're surviving. They're living somewhere, they're paying rent, and they're paying for food. So we came up with some guidelines, right? These are approval guidelines that we give to the banks who write our loans. And we say, all right, the borrowers need these guidelines, then we would approve them. So let's say you don't have any other credit history on your credit report, but you can prove that you've paid your rent on time for the last 12 months and that you have some money in the bank, right? So let's say they did that cash to closing, right? Let's say it's going to take $15,000 to get into the house you want to get into, and you've got $5,000 of your own money, and you can also get a $10,000 grant, right? So now you're up to $15,000, and let's say you can get a gift from a relative of $5,000, right? Now you're up to $20,000 available. So it's going to take you $15,000 to get in. That means you have $5,000 left over. So you would have what we call reserve money in the bank after closing. So if you can prove you paid your rent on time for 12 months, and it has to be documented in a certain way, right? And we look at the money you have available for the transaction, and you'll have a couple months mortgage payments in reserve, then you can get an approval from SONYMA on a SONYMA loan without any other credit history, right? You can even get approved if you have no rent history, no other credit history, but you have the 2 months reserves we're talking about here in the bank after also having the money that you need to close. You can do that. What we do on that, though, is we make you meet tighter debt to income ratios. Probably one is more that Susan prefers anyways with her agency. There we limit the debt to income ratios to 35% of your gross monthly income toward the mortgage payment and 40% toward the mortgage payment plus all your other debts. You don't have to go build yourself a credit history by getting credit cards or a car loan or something and doing that. If that's not how you used to live, we're fine with that. We'll approve somebody with no credit history, with no rent history, who can come up with the cash to close and also have 2 months mortgage payments still in the bank after closing if they meet the debt to income ratio requirements. So that's pretty unique. And I think I'm kind of a mortgage nerd, right? I've been doing this so long as Paul. It's extremely unique, like almost revolutionary within the industry to do that. So we've also like softened up. We used to require pretty good credit, right? Like you could get turned down for a Sonny Mae loan in the past, but still get an FHA loan because their credit were a little more lax than ours were. But what we're looking at is your payment history. So if we see on your credit report that like there was a 60-day late payment on something in the last 12 months, as long as you have on-time rent payments and 1 month's reserves, we're good with that, right? And we'll also allow for a couple 30-day late payments. So you don't have to have perfect credit to get a Sonny Mae loan. Again, with Sonny Mae, we don't really consider your score. So I'm going to talk to you guys a lot about the score. If there's borrowers out there, right, let's say they had a bankruptcy in their past, need to be 4 years from the bankruptcy, 2 years from discharge, and you have to have reestablished. Talk a lot about that because I don't think that's one of the really features of Sonny Mae that differentiates itself from any other loan program. But if you have had a bankruptcy in the past, as long as you've reestablished good credit, eligible. And same thing with foreclosure. If there was something that caused you to have a foreclosure, you need to be a certain number of years past the foreclosure and you have to have reestablished credit. So that's kind of the credit innovations that Sonny Mae has made to try to make it easier for folks to qualify for credit that we believe they deserve. Right? This isn't an entitlement program or anything. This is, you deserve the same shot at getting credit as other borrowers do. We're just going to look at it differently. Then we're going to talk about the cash piece. Sonny Mae, with every Sonny Mae loan, there is available what we call a DPAL, a down payment assistance loan. So offers borrowers money they can use toward down payment closing costs, which is available right on all of our loans. There's no payment on the Sonny Mae DPAL loan. Right, so typically what it is it's 3% of the purchase price of the property in most cases. Now we're going to talk about an enhanced version of that in here. So if you're buying a $150,000 house, right, and you're going to need $4,500 down, which is 3%, we'll give you that DPAL loan for $4,500. So you just came up with your down payment. It doesn't, like I said, there's no repayment on that. There's no monthly payment on it. It's forgiven over a 10-year period. There's no interest on it either. Right. It does, however, impact the mortgage rate that you might get on the first mortgage with the Sonny Mae loan. So that's one resource, right, for you guys to come up with extra cash to get into the home. And I know that TRIP and Affordable Housing Partnership, they have access to lots of other programs and grants and things like that can help you out. So to help with the upfront costs of purchasing the home, right? We've offered the down assistance loan to borrowers. With this Give Us Credit expansion, right? I know I said it was 3% of the purchase price, but let's say you qualify in every other way for that $150,000 home, but you're a couple $1,000s short on the cash to close. You could bump that $4,500 DPAL on the $150,000 home to a $7,500 DPAL to kind of get you over the hump with the cash to close calculation. And that's all part of this new Give Us Credit from Sonny Mae initiative. The reason we've kind of named it and labeled it and we differentiated this because we're going to track how these loans perform and we're betting that they perform as well as other loans. So, right, you go see Paul, you're telling him how much money you got to use toward the purchase of a home. And he's like, okay, you told me you had $5,000, but I don't see it in your bank account. And you're in, oh, that's because it's in a coffee can in my apartment, and that's where it is. That's always been difficult for banks in the past, right? They don't like to see unsourced money go into your bank account during the process of you applying for the loan. Sonny Mae has a minimum borrower contribution of seasoned money, right? So typically that's 1% of your purchase price that we want you to have into the transaction in your own money. But once you've met that, we'll allow up to $5,000 of these unsourced funds, right? Which would be the mattress money, the money you have in the coffee can, or something like that, that you can then deposit into your bank account during the transaction. Just tell us that's what it is. It's unsourced money, cash that you had in your home, and we'll allow you to use that toward the cash to close. So it has to be deposited into your bank account. So basically, this is what we call unsourced money, right? Didn't come from your paychecks, didn't come from a gift or any other documentable source. It's just cash that you had on hand. So we allow that right, up to $5,000 or up to 50% of your gross monthly income, right? So if you make $5,000 a month, we'll allow you to use $2,500 of that unsourced cash. And it requires a receipt from the borrower that says, I didn't borrow this money, because if you borrowed it, then we'd want to see what payment is on it to put that into your debt to income ratio, and then we start chasing down that hole. So also, loans from family members are permitted for down payment and closing costs, right? So if you have, actually, it doesn't even have to be from a family member. If you get let's say, you don't come from wealthy parents, but they say, well, look, I can give you $5,000, but I'm going to need it back. You can set up a loan agreement with them and use that money for a down payment. There's also, and this is more downstate, I think, than around Albany area, but I think we're starting to see a little bit of it up here. There's these non-traditional shared savings arrangements, right? They're called SUSUs or PARDNAs. And basically, a person participates in this program with this group. It's kind of like a club. They put some money in each month, and at some point when they go to buy a house, they're allowed to draw money out. Maybe that's even more than what they put in to get there. And those things by SONYMA. So again, to count towards your cash to close. So you know how Susan was scaring you with kind of those numbers of here's how much you need to get in. Now we're kind of starting to put it back together for you to show you here's some ways that you, because a lot of us don't start out with that much money out when we start thinking about buying a house. So now we're going to talk about capacity, right? What are we counting in your income when we're calculating those debt to income ratios? Right? Traditionally, if you worked overtime, you would have to have a 2-year history of overtime in order for us to count that overtime in your monthly income and your debt to income ratios. Now, if it's a field where we typically see overtime is fairly regular and normal, like nursing or a municipal employee, like the snowplow driver in the winter, right? Around here, then if there's a 12-month history of it, we will allow it to be used towards your capacity or your debt to income ratios. You can also get, now on a SONYMA loan, a non-occupant co-borrower, right? Let's say you're going to buy this house, but you're having trouble meeting the debt to income ratios. Maybe you work a job, right, where you make some cash income that doesn't always appear in your W-2 at the end of the year, like a bartender or something like that. Whatever reason, but you can afford it. But when we put all the documental resources together, we're finding that your debt to income ratio is too high, or that you don't have enough, enough credit depth on your own. You can get a cosigner, what we call a non-occupant cosigner, right? So that could be, the most common person to do that would be a parent, right? And what we do is we would kind of aggregate together you and that other non-occupant co-borrower, and as long as the ratios came out okay on the debt to income ratio, then that would help you qualify as well. So that can be used to assist you with income qualification, also with credit history qualification. And again, there's no restriction on relationship on this non-occupant co-borrower. Border income. I'm not going to talk too much about border income, but let's just say you've lived with a roommate for 2 years, and that roommate has paid half the rent and half the household bills, and now you're ready to buy a house, but that roommate isn't. So that roommate says, "Hey, can I tag along with you and just rent from you in your house?" And you say yes. You can count some of that assistance you're going to get from that border, right? That's called a border because let's say you're buying a single family house. Then you can count some of the assistance you're going to get from that border towards your debt to income ratios on a SONYMA loan. There's a lot of restrictions that apply, so I didn't list them all here, but your loan officer will be able to discuss them in detail with you if it looked like it was something that could help you out. We also allow...
interrupt, Bill?
Yeah.
Bill, can I interrupt for 1 second?
Yes.
Because we've got a good question here in the chat, and it's basically, can an occupant or spouse be a co-signer? So how would you treat that? Does a co-signer make sense, or would they be on the mortgage? How would that work?
Well, co-signer is that non-occupant co-borrower that I just talked about. So obviously, if it was a spouse, it wouldn't be a if it's a spouse and you would apply together, because you're both presumably, if you're spouses, you're presumably both going to live in the house. It kind of goes without saying, but I didn't mention this, but SONYMA only allows owner-occupied properties. And what was the other half of the question, Sue?
Right, whether it's can an occupant slash spouse be a co-signer? So different from is the co-signer on the mortgage? I guess it's a little technical question, maybe. I don't know.
technically the cosigner just signs on the promissory note to borrow the money. They don't go on the deed to the property. I mean, if you have a spouse, your spouse is usually on a spouse is not an allowable non-occupant co-borrower because they're going to be living there with you, so they wouldn't be a non-occupant. That's the assumption, right? I mean, most of us live with our spouses, at least for a while. Anyways, so a spouse would not qualify as a non-occupant co-borrower. So how am I doing on time? I haven't really been keeping track of time. I don't want to go over. So I want to talk about, let's say you find a house that has an in-law unit in it, right? That's it's a separate dwelling unit in home. I mean, I live in a house with an in-law unit because my mother lives here with us and she has her own part of the house. You can use rental income from that in-law unit or that accessory unit to qualify for a Sonny Mae mortgage, right? As long as it's a legal accessory unit. And again, the loan officer will give you the details on that. And last, we're going to talk about getting you into the home, right, and the collateral. So this is a temporary program, and as soon as it's got a limited amount of funds that was funded by the state, it's called DPAL Plus, and this is a really cool program. I think it's probably got at the pace we're going a couple more months before it runs out of money. So but we do have an assembly member on the meeting here, maybe still, so we could pitch to them to maybe do some more of this. But this was money that came from like a settlement with a bank that did something wrong. So we put it into what we call DPAL Plus. So again, it's a limited product with a finite amount of funds, but it's a really cool product, right? A borrower who qualifies, there's income limits on this. There's also purchase price limits on this. The income limit is 60% of the area median income. So I think in Albany County, that brings you in like 50-ish or in the 40s somewhere. Sue would know better than me, depending upon your household size. But you can get up to $30,000 of DPAL, down payment assistance loan money, right? Which is money that doesn't have to be repaid in monthly payments. It's forgiven over 10 years to help. Basically, what we're trying to do is help borrowers get to 20% down so they don't have a PMI payment. So if you meet the income limits, you cannot have a purchase price over $175,000. So this is truly more for the low to moderate income folks. Again, the goal of that money is up to $30,000 to cover down payment and closing costs to get the borrower to a position of 20% equity in the property where they don't have to pay PMI. And or you can use the money to pay what we call a single premium PMI so that PMI doesn't become part of your monthly mortgage payment. So really cool program. The income limits are based upon the county where the property is located. And again, it's a limited time offer. So there's up to $30,000 of down payment and closing cost assistance available in that program with Sonny Mae. And again, it's called DPAL Plus. So example, right? I wanted to put some numbers together. So $100,000 sales price. I know you can't find a house around here for $100,000 anymore. Actually, I shouldn't say that because I just saw one recently that was a $100,000 price. So there's still a few of them out there. $100,000 sales price with $6,000 in closing costs, right? That includes like the tax escrows and all that stuff. So the borrower would use DPAL Plus money of $6,000 for the closing costs. They would use DPAL Plus money of $20,000 for a 20% down payment. They would then just have an $80,000 mortgage on the property and whatever payment that yielded for them, right? As long as they were under the household income limit for it. Example number two, right? Let's say Affordable Housing Partnership or TRIP finds you some other grant money as well. You have a $100,000 sales price, $6,000 in closing costs, and there's $12,000 in some other grant. We want you to use that other grant money up first before you use the Sonny Mae money. So in that case, the $12,000 in other grant or subsidies would pay closing costs and $6,000 of down payment. And in that situation, you'd use $14,000 of Sonny Mae DPAL money to get you to that 20% equity position where your first mortgage is only 80% of the property. And that would get you a payment without any PMI and get you a lower payment, right? And it's less risk to us because you've got more, you've got more equity in the property. So that's pretty exciting product. It's limited amount of funds. Again, I'm going to say there's about 2 months worth left to get to find a house, and this money will still be available. Otherwise, it will probably run out at like the end of the summer. So we'd like to say a special thank you again to Assembly Member McDonald for making this possible. And I also want to say you've got, and like Susan Cotner, who's moderating this from the Affordable Housing Partnership, and TRIP, right? They're in Troy. These are nonprofit housing counseling agencies. Right? These folks get up and go to work every day and are underpaid because they're kind of dedicated to the mission of helping people out to get into their first homes. They do a really awesome job. They do things right. They are trustworthy and they are accountable. And the reason I say that is because you hear stuff on TV and radio all the time about, you know, come talk to us about debts you have or whatever. These folks do it right, and they know it inside and out. They study hard, they work hard. So all the things that they offer, right, the home buyer classes that they offer will get you super prepared and will save you a lot of money in the home buying process if you're working with them. So again, thank you to Assembly Member McDonald, and that is it for my presentation.
That's awesome. Thank you for that little plug there. It's greatly appreciated. So we do have some questions for you, Bill. One question is, can you use a Sonny Mae loan for construction of a new home, or does it only qualify, can you only use it for an existing home?
Sonny Mae funds can only be used for an existing home. So you can use it as like the end loan when if you're having a new home constructed. When that home is finished and you can roll into what's called your permanent financing, which would be your normal 30-year fixed rate mortgage. You can use a Sonny Mae loan for that, but you can't use it on the construction phase of the loan. But as kind of a sidebar to that other thing Paul talked about, right? Like a purchase rehab loan. So if you're out there looking and you find a house, but the house needs, $20,000 of work really to be brought up to code and to be livable and all that. Sonny Mae has a really awesome, what we call Remodel New York program, where you can finance the purchase price of the home and repairs that you want to do to that existing home or that need to be done to that existing home after you buy it into one mortgage loan at a really low rate.
Yeah, that's a really great product too. We've got some income limits. Paul has shared that again, and I'm not sure if this is, Paul, maybe you can explain what the limits are. So for a 1- and 2-person household, $58,200, you can earn up to that amount and qualify for the Give Us Credit program.
The DPAL
Plus. Okay.
So here's something.
Yeah, go ahead.
So
this is.
My boss is monitoring our conversation, I guess. I don't know if this is just random, but I just got a text message that says new legislation was just passed that will allow Sonny Mae to do construction lending in the future. So we'll probably have a product coming out soon to help with that.
That is amazing. That's great.
I don't think that was random. She must have a fake name and be on the webinar or something.
Yeah, no. I do want to say that Sonny Mae has a really fabulous website, and if you go to sonnymae.org, you're going to find a lot of answers to your questions. So Bill's wonderful, but you might have a question later tonight. So I do encourage you to check out that website. It's very easy to navigate, and it'll get you to all the information on the income limits and that type of thing. So yeah, it's a great resource. So. Any other questions for Bill before we move on to Nicole and grant monies and down payment assistance? All right, take it away, Nicole. Thank you so much.
Always have to find the unmute button. Thank you. Hi, my name is Nicole Casal, and I'm coming from my home, but also from TRIP and RCHR NeighborWorks Home Ownership Center, and I will be presenting tonight on Capital Region Down Payment Assistance Programs. So where are we going to begin? So first, what do you need to be eligible? And the answer is it really does depend, because different programs, they're going to have a lot of different requirements. But here's kind of a broad overview of what they typically do require. So the first thing is that pre-purchase counseling and homebuyer education, as Sue mentioned before. And with that pre-purchase counseling, that's where you really get the one-on-one with a counselor to go over your financial situation. Now, what is that savings? What is the credit? All of that fun stuff. What is affordability and loan products? And then that homebuyer education piece, this is typically going to be a 6 to 8 hour class, whether in person or on Zoom. So with that one, that's going to be a little bit different from those one-on-ones, because there are just a lot of great information on that the whole homebuyer process. Some of the down payment programs require you to be a first-time home buyer, which we're going to delve in really quick in the next slide or two. And then a lot of them have those income limits. So depending on the location, those income limits are going to vary, and the grant product. So then cash. So as Paul had mentioned, even if you are utilizing down payment programs, a lot of them still are going to require cash towards that transaction. And then the last one, and while there can always be lots more, the one that we're going to touch on is landlord training certificate. And this would be specific for if you were utilizing a down payment program and purchasing a multi-unit. Now, they do not all require a landlord training certificate. And in order to get that certificate, it would be attending a landlord training class that is offered both by AHP and TRIP and others in the area. But again, not all of the down payment programs require it. Some lenders also require that certificate. So those are some things that you would need in order to be eligible for that program. Now, how can that money be used? Again, it really does depend on what type of down payment program it is. So a lot of them, they may offer funding to go specifically towards closing costs and then down payment. Some are only specific towards renovation costs. So you really do want to be aware of what those programs are going to go towards. Because if you are, and we're going to talk about that shortly, utilizing the NRP, which is for renovation, and you're not utilizing any other down payment programs, you want to make sure you have that funding for the down payment and closing cost. So you really want to know, ask that housing counselor what programs are going to be best to utilize. And then there are some that allow for some upfront cost. Not a lot of them. A lot really do focus more on the closing and the down payment. So as I mentioned, some programs, down payment programs require you to be a first-time home buyer. So I really just wanted to throw out there, what does that mean? So the first one's pretty simple. I've never owned a home. So that would mean I'm a first-time home buyer. So then it kind of gets a little trickier. So let's say that you did own a home, but you haven't owned it in the past 3 years. Well, then you are a first-time home buyer again. Yay. And then the next one is if you've owned a home with a spouse, but you've separated and will be purchasing a different home on your own, you can now be considered a first-time home buyer. And then the last one is if you've owned a home, but it's not affixed to a permanent foundation. So you, again, are a first-time home buyer. So those are sometimes eligibility requirements for the different programs. And then the next one, we're not going to delve too much in this. Just somebody asked in the question, so I hurried up and I grabbed a screenshot that I had of some income guidelines, but this will be in the slides after this presentation. So some programs require you to be maybe 80% below or 60%. So for instance, if one program requires 80% and you're a household of 4, you would need to be under that 76,500. So this is just for your viewing pleasure for after the presentation. So things to keep in mind when you are utilizing grants. So one thing is that some of them require a lien put on the home. And what does that mean? It means that, well, they have a time frame that they typically want you to be in that home in order for that grant to be forgiven. So usually it's going to depend on that program, what that time frame is going to be. If you move out prior to that time frame, you may be required to pay back all or a portion of it. And those are things that you would want to know before taking advantage of that grant. And then the other thing are the different ratios. As Paul had mentioned, we at TRIP, we have, and I'm sure others, they have their own guidelines. So ours is the 33/42. And when you are going over that affordability piece, the lender, they're going to have to go with whichever one is that lower amount. So even if you are utilizing a 40-45% housing and debt ratio, but then utilize a grant that has lower ratios, you're going to have to go with that. So they're all just things to keep in mind when taking advantage of grants. So now let's talk about a grant. So we've got the Homebuyer Dream Program, and this is funded by the Federal Home Loan Bank of New York. So you may have heard of this, from friends, family, or other people. Now this funding round, it opened up in May. And in order to qualify for it, you do need to be a first-time home buyer. You need to meet those income guidelines. So with this one, as you can see in the capital region, household of 1 or 2, you would need to be under the 77,600, and 3 or more. So it doesn't matter if you're 4, 5, 6, you would need to be under the 89,240. Now there are a few things in here that I'm not going to touch on because there are a few different, eligibility requirements. So you would definitely want to contact a housing counselor. So another thing with this is you would need to find a bank or credit union that are participating in this program, because they are not all participating. And then how much is available is going to be dependent on that bank or credit union. I will say that we found locally, the majority of them are going with that 9,500. And this goes towards closing costs, down payment, and there are some upfront costs as well. And you can purchase in New York, New Jersey, Puerto Rico, and the US Virgin Islands. I like saying that. I don't know why. So another qualification for this is that you need to have that pre-purchase counseling and education. There is that lien on the home for the 5 years. So if you do move out prior to that, it is prorated. So a small portion is taken off every month. But no, you buy the house, just stay there. And then what else did I want to say about this? I don't know. You've got it there. So you've got the home. Oh, another thing. With this one, the funds that are available, you cannot actually apply for this unless you meet all of those, and then you are under contract with a home. So this one's a big piece because you're not going to know if the funding, if you are approved for it, until after you've kind of gone through the process. You found your house, you put an offer, you got accepted, you're under contract, and now this is when you can actually apply to the program, as long as all of the other things are met as well. So that is the Homebuyer Dream Program. It's a great program. And another thing that I didn't mention is that a lot of grants you are able to stack on top of each other, which is just wonderful. Who wouldn't want to utilize as many grants as possible? So this one does stack nicely with a lot of other down payment programs. So that is the Homebuyer Dream Program. All right, after that, we have the SONYMA Down Payment Assistant Loan, or the DPAL, which was previously spoken on. So we're not going to spend too much time here. As it was mentioned, this is, it's a 0% loan. It's forgiven after 10 years, up to 3%, or a max of $15,000. So income guidelines, it's going to be, here are the income guidelines, and they are actually slightly higher if you are purchasing in a target area. So one thing to keep in mind is that this is a 0%, but for the first mortgage, it will raise that a very small percentage. But you can definitely utilize this to go towards that down payment. So that's the DPAL. And then moving on with NRP, still with SONYMA. So this is the revitalization program. So I also feel like we should just have a cheat sheet because there's so many different acronyms with everything. It's just so much fun to remember. But with this program, this is specifically for renovation cost for vacant buildings. So it's definitely a great program to stack with a grant that is specifically towards closing and down payment. And then on top of that, having this for renovations. So it does need to be vacant. As I mentioned, it is for 1 to 4 units, and you can use this in Albany, Rensselaer, Schenectady, and Schenectady counties. This one, you do not need to be a first-time home buyer like you do with other programs. But you do need to, this does need to be the primary resident. So that is the SONYMA NRP. And then there is the New York State Affordable Housing Corporation, AHC Rehab Program. So this is up to $35,000. It's going to be based on need, health and safety, and it's only available for single family home and owner occupy. All right, so that is, and this is, again, you can stack this. This does not have to be for vacant buildings, and it will be for renovations. So now some specific areas. In the city of Albany, we have HAP. So this is the Home Acquisition Program. So City of Albany, they provide up to 5% of the purchase price up to $10,000. And in addition to that, you may be eligible for $5,000 in closing costs. This is a 1 to 4 unit. Again, this is specifically for City of Albany, and you do need to qualify with those income limits. I believe it's under 80%, Sue? Yes, okay, great. And there is that 5-year lien. So the goal with these programs is that you are purchasing in the area and that you are staying and kind of building up that area. So that is kind of that big goal of all of us. So in addition, they also have rehab programs. So there is RAP and TARP. Now for these, this is for $5,000 in the RAP for emergency owner occupied. So again, this is going to be geared towards health and safety, and the tenant. So that's going to be the owner occupied. And then the TARP, this is for affordable rental units with a max of $6,000 per bedroom. And again, you're going to receive these slides after, because if you are interested in any of these programs, definitely give the contact a call. So other areas in Albany County, ACRA, they have a grant available specifically for Albany County outside of the city of Albany. So they have availability for closing costs and down payment, as well as a renovation. And one thing that I didn't mention with all of these is you really do want to give the housing counseling and agency a call to see if the funding is available, because with everything, you know, we get the funding and then we spend it and then we get more. So, you know, it's kind of that revolving. So you would always want to make sure that there is funding available with all of these programs. So with this one, there is the acquisition and rehabilitation grant. And then they also have the home down payment assistant grant, which specifically goes towards closing and down payment. With the home program, you do need to be that first-time home buyer. You need that pre-purchase counseling. And with this one, you do need to have $1,500 in a bank account in order to qualify, along with other qualifications that you would want to call and find out. And one last one for Albany County. So Town of Colony has a first-time home buyer program as well. Need to have that be that first-time home buyer, have that home buyer ed certificate, so that pre-purchase counseling and education, and it does have that 5-year lien placed on the home. You definitely want to give them a call to see that funding availability and see what that wait list is for that program. And then we have the city of Schenectady, because we are all over. We're all over the place. With Schenectady's second mortgage program, so what they offer is not a 0%. They offer a second mortgage for up to 10% of the purchase price. There is a lien on the home for 5 years. So staying in the home, and part of it does have to be paid back. So over the course of the 5 years, 25% does need to be paid back at 4%. But as long as you're in the home for that 5-year period, 75% will be considered a grant, and that will be forgiven. So another really great program. And then we have in the city of Troy. So in Rensselaer County, City of Troy, we have the HIP program, which is the Home Buyer Incentive Program. With this one, the funding amounts are either $15,000 or $20,000, depending on income, household size. And this one is good for a 1 or 2 unit. Like everything else, pre-purchase counseling, first-time home buyer. With this program, the house also does need to meet code, which is another thing that you would need to double check. And then the last program in Rensselaer County is the Small Cities Program. So this is for Rensselaer County, except for Troy or Lansingburg. This is for a single family home and up to $35,000 depending on need, income, and household size. And with both of those programs, there is that 10-year lien on the home. And now moving on, we have the Restorative Housing Justice Fund. So with this one, it's available in the Capital District up to $10,000. So if you are purchasing specifically in the city of Albany, it's $10,000, and anywhere else in the capital region, it's $5,000. So in order to be eligible, you need to purchase in the capital region, and then you also need to be a home buyer who identifies as Black or African American. With this program, there is no lien that is on the home, and it does, like everything else, it stacks nicely with other programs. And then we have the New York State Association of Realtors Housing Opportunity Foundation. So they offer a $2,000 grant. This is on a lottery system that they do on a monthly basis. In order to be eligible, you do need to be working with a realtor. And if you take homebuyer education, you have that homebuyer ed certificate, you get an extra name in that drawing. So good thing to add on. And then just, you really want to shop around to see if lenders have their own programs in addition to the down payment programs in the area. So some of them do offer, money to go towards down payment, to go towards to have mortgage insurance waived. So something to definitely research. And then we have our contact information. So if you are interested in any of the programs, really just contact a housing agency. Now, one thing that I like to say is that we all work really nicely together. We refer people. If you're interested in one area, then we refer you over to them. So you may do your counseling and education with one agency and then decide to go purchase in another area. And, like I said, we like each other. We all work well. So it doesn't necessarily matter, where you go, we will all try to get you to the right place. So what do you do next? So everyone who is registered for this presentation they are going to get an email after of the different PowerPoint slides. And if you are interested in moving forward, feel free to contact any of those homeownership agencies. And one thing that I like to throw out there is, when should you contact them? Maybe you're not necessarily ready to purchase right now. That doesn't mean you shouldn't contact us, because what we want to do is we want to see where you are right now and see what those goals are that you have, and kind of help you come up with those next steps to get to that goal. So call us now or whenever you're free. And are there any questions? I can't see anything when I have this slide up.
That was great. Thank you so much. So I think Bill wanted to make a comment on the NRP program, which is that renovation product.
Yes, we just made some changes to that. So I'm going to give you the good changes first, or what I perceive to be the good changes, right? No longer does the house have to be vacant. Oh,
I've been waiting for that.
So, and now it's not restricted by county. It can be any property in New York State.
Oh.
It can be vacant or occupied. The downside changes, I think, or that make it a little more restrictive, is borrowers do now have to be a first-time home buyer, and they have to fit our Achieving the Dream or Homes for Veterans criteria. Basically, Achieving the Dream is 80% of median income. Though, if it's a veteran, they'll go to 100% of median income on the household income limits. Those are them. And then what repairs you can fund with the program have changed also. So we've gotten that out to the lenders. I apologize. I didn't necessarily proactively get it to you guys at the agencies. Paul is already painfully processing that information to figure out what he can do with it to help borrowers out.
Yay.
That's not bad.
That is huge. Yeah, that's great. There's a bunch of existing housing stock in the capital region that needs you guys as first-time buyers to take advantage of this great NRP program to update it. So that would be wonderful. Great. All right. Are there any other questions that people have for these guys who work with first-time buyers every day? Bill, Paul, Nicole. All right. Well, like Nicole said, we're definitely going to be getting you all these slides. We'll get you the link to the presentation. There's one question about, what's the timeline for buying? And really, you are the one that's going to dictate what's the best time frame for yourself. We do hope that you're ready. You get ready first, and then when you are out looking, you can quickly. And this is unfortunately with this competitive housing market, you want to be able to move very quickly to be able to move towards your purchase. So again, the more prep work you can do up front, get that loan pre-qualification, and then begin that research, working with a realtor so that when you see something that you're ready to move forward. So again, that's definitely you're the one in the driver's seat on that. We have a question about whether or not SEFCU works with Sonny Mae, and yes, they've got, like Paul, they've got a couple of loan officers that I know that are that really specialize in Sonny Mae, so yes, they do. There's a second question about do we recommend that you do the workshops first? And we do recommend, that the more knowledge you have up front at the beginning of the process, the better. Again, you're just going to be, like I said, more ready to go. So not that you want to necessarily get it out of the way, but we do recommend that you take that as it's a very good first step to kind of build off of a base. And then when you've got all these other people that will be working with you, your realtor, your attorney, your home inspector, you'll have that great base of knowledge so that you can really take advantage of their time and their expertise and really get the right house for you. Any other questions on that? Let's see. Is there any program for someone that lives in a house now that needs renovation? I think I've got that question right. And yes, so most of the municipalities have some kind of home repair program. I know that our agency, TRIP and ACRA and Better Community Neighborhoods, we do have home repair programs that we'd love to tell you about. One kind of statewide program is an energy efficiency program through NYSERDA. Every county has a weatherization program. So again, connect with us and we'll find out what your home needs, and we'll be happy to get you on board with those programs. The question that was being asked about the timeline for buying actually is also the timeline for closing, right? Once you're under contract, Paul, typically, how long does it take? Once you're under contract, you've applied for a mortgage loan. What's the timeline for closing?
Generally speaking, you should expect 45 to 60 days. Longer for renovation.
I know that it's taking a bit because the market is so hot right now to get basic work done on the title, right? Title reports are taking several more weeks than they used to in the olden days, 6 months ago, to get completed. So sometimes there's things beyond your control in terms of closing. So our recommendation is don't give a notice to your landlord until you're really, really ready to go. Might take longer than you hope. Let's see, here's another question. Let's see, if anyone's living in a house that's going on the market, but the owners are in a rush, why would they want to wait for you? Yeah, that's tough in this market right now. But again, I think with programs like Give Us Credit, right? If you've got a great rent payment history, you definitely want to have that conversation with a lender right away. And again, Bill, they're not calling Sonny Mae directly, right? They're going to be calling the Paul Hurleys of the world or a loan officer. You have on your website, right? A bunch of
on the Sonny Mae website, which is sonnymae.org. you can see a list of participating lenders. You can also see a list of what we call Hall of Fame loan officers. These are the loan officers that do the most Sonny Mae loans, so they're probably the most familiar. And Paul is a member of that Hall of Fame. I can tell him right now, actually, because we just finalized the numbers that he was, again, this past calendar year in the Sonny Mae Hall of Fame. So great job, Paul.
Thank you.
Woohoo! Yeah, no, it's great to work with the experts. And it's great that Sonny Mae shares that information with you so that you know who to ask for and work with. All right. Any other questions?
We did
Again,
good.
we
We're
are,
like right up at 7 o'clock almost.
Yeah. Perfect timing. So again, we want to be that resource for you. As Bill implied, we've been around, and you know, really, it is our job to understand the different down payment assistance programs and mortgage products, and we love working with good lenders who really want to help you be successful with your home purchase. And it's exciting to be able to have Sonny Mae be so responsive in terms of really understanding credit and that type of thing. I think I'll leave you with these words. The fact that, you know, you can close on a really great loan product, even though you've had 1 or 2 late payments within the past year, that's huge, because if you have a 30-day late payment, your credit score is dropping 100 points, right? So that might knock you out of the ballpark for any other mortgage product. So again, you may be in a good position to buy. If you've got strong rent payment history, they disregard medical bills, you know, it's all really good stuff. So, all right. All right. Well, we'll stay on, but I think what we'll do is let folks have a great night, and the presenters can stay on. We can answer a few more questions. But again, thanks so much to Assemblyman McDonald for hosting us, and everybody have a great night. Thanks again. All right, I think Nicole's answering some questions in the chat. So excellent. All right, good. All right, thanks, guys. Thank you so much for being here with us tonight. We really appreciate it. Thank you. We'll do it again.
Great. Thank you.
Take care.